Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that could reshape the entire global financial landscape. We're talking about the potential next chairman of the Federal Reserve, a name that's sending shockwaves through Wall Street, Kevin Warsh. Now, why is this one person so important? Because the Fed chair holds the keys to the world's largest economy, and their decisions ripple out to affect everyone's wallet, from mortgage rates to the stock market. So, who is Kevin Warsh? He's a former Fed governor, a distinguished fellow at the Hoover Institution, and he's now being tipped as the frontrunner to take over from Jerome Powell in May 2026. What makes this so fascinating is that Warsh is a walking contradiction in the eyes of the market. He's traditionally known as a hawk, someone who favors higher interest rates to fight inflation. But here's the twist. He's also signaling that he might be in favor of cutting rates. How can a hawk be a dove? We're going to unravel this paradox. First, let's talk about his support network. When you see who's backing him, you start to understand the gravity of this potential nomination. We're talking about financial titans like Scott Bessent, the former chief investment officer for Soros Fund Management and founder of Key Square Group, and Stanley Druckenmiller, a legendary investor who needs no introduction. These aren't just casual endorsements. These are heavyweights throwing their full support behind Warsh, which gives his candidacy immense credibility and political momentum. Bessent has even publicly stated he's advising the campaign on economic policy and that Warsh is his top pick for Fed chair. This is a powerful coalition, and it means we need to take Warsh's ideas very, very seriously. Now, let's get to the core of his seemingly contradictory stance: cutting rates while being a hawk. The key to understanding this is one single powerful force: artificial intelligence. Warsh is making a bold bet on AI. He believes that the rapid advancements in AI are about to unleash a massive wave of productivity across the economy. Think about it. AI can automate tasks, optimize supply chains, accelerate research and development, and make businesses hyper-efficient. This surge in productivity, in Warsh's view, is a powerful anti-inflationary force. When companies can produce more goods and services with fewer resources, it naturally pushes prices down. It's a supply-side revolution. So, while other Fed officials are looking at lagging economic data, Warsh is looking ahead, arguing that this AI-driven deflationary pressure will do a lot of the Fed's work for it. This allows him the room to advocate for lower interest rates. He's not being soft on inflation. He's arguing that the battlefield is changing. The technology itself is fighting inflation, giving the Fed the green light to ease monetary policy to support growth without risking a price spiral. It's a forward-looking perspective that challenges the traditional, reactive stance of central banking. But hold on, it gets more complex. While he might be open to cutting rates, he's absolutely not a fan of the Fed's massive balance sheet. This is where the hawk in him really comes out. Warsh is a strong advocate for quantitative tightening, or QT. For those who aren't familiar, during crises like 2008 and the pandemic, the Fed bought trillions of dollars of government bonds and mortgage-backed securities. This is known as quantitative easing, or QE, and it effectively pumps money into the financial system. Warsh argues this has gone on for too long and has created a dangerous situation. He believes the Fed has essentially been monetizing the debt, which is a fancy way of saying it's been printing money to help the government finance its spending. This blurs the lines between the central bank and the government's Treasury Department, and Warsh sees this as a fundamental problem. He wants to aggressively shrink the Fed's balance sheet, selling off those assets and pulling that excess money back out of the system. His goal is to restore a clear separation of powers. This brings us to his core philosophy about the role of the Fed. Warsh is a purist. He believes the U.S. Treasury should be solely responsible for managing the nation's debt. If the government wants to spend a lot of money, it's up to the Treasury to figure out how to finance it by issuing bonds to the public, not by relying on the Fed to be the buyer of last resort. In his view, the Federal Reserve has a dual mandate, and a dual mandate only: to maintain stable prices and maximize employment. That's it. By getting involved in managing government debt, he argues, the Fed has been distracted from its primary mission and has distorted financial markets. So if Warsh were to become Fed chair, what would this new world look like? Picture this: a Federal Reserve that is simultaneously cutting interest rates to stimulate the economy, thanks to the deflationary power of AI, while also aggressively shrinking its balance sheet to stop propping up government spending. This is a combination we've never really seen before. Lower rates could be a huge boost for stocks, especially in the tech sector, and for anyone looking to borrow money. It would make mortgages cheaper and business loans more accessible. However, the aggressive quantitative tightening part is the wild card. Pulling trillions of dollars out of the financial system could create volatility. It could make it harder for the government to finance its deficits, potentially leading to tough political choices about spending and taxes. This two-pronged approach, rate cuts plus aggressive QT, is a radical departure from the policies of the last 15 years under Bernanke, Yellen, and Powell. It would be a complete reset of the central banking playbook. This potential shift signals a move away from the post-2008 era of constant central bank intervention and toward a new paradigm. One where technology is seen as a key macroeconomic force and where the Fed returns to a more limited, traditional role. It's a vision that has the backing of some of the smartest money on the planet. Of course, a lot can happen between now and 2026. The economic data could change, the political winds could shift. But the fact that these conversations are happening at the highest levels tells you that big changes are on the horizon. For decades, we've been told the Federal Reserve is a fiercely independent island. But that's about to change. Enter Kevin Warsh and a proposed new accord that could fundamentally redefine the relationship between the Fed and the U.S. Treasury. We haven't seen an update like this since the historic 1951 agreement. Why now? Well, with U.S. national debt hitting a staggering $38 trillion, Warsh argues that the Fed and Treasury are already secretly bound by fiscal reality. Instead of pretending the Fed is an island, Warsh wants to bring this stealth debt financing out into the light, formalizing how these two giants cooperate. But there's a catch for investors. This new framework could put a leash on the Fed. Under Warsh, the Fed might only be allowed to launch quantitative easing, those massive Treasury purchases that save the day during crashes, with Treasury approval and under very specific conditions. In short, the Fed put, that safety net we've relied on for years, might be getting significantly weaker. So, where is the money going? Warsh is expected to aggressively pivot the Fed's portfolio. Currently, short-term Treasury bills make up only about 4.4% of the Fed's assets. Warsh wants to skyrocket that to 55% over the next 5 to 7 years. The goal? Lowering the government's credit card bill. By flooding the market for short-term bills, the Fed drives those specific interest rates down. This lets the Treasury roll over trillions in debt at a lower cost, while leaving long-term rates to be decided by the open market. This is why analysts are calling Warsh a hawk in dove's clothing. Traditionally, he's a hawk, someone who likes tight money and high rates. But this plan to lower government borrowing costs is an olive branch to the Trump administration. If you were panicking about Warsh being too hawkish a few weeks ago, you might have been misreading the play. But don't get too comfortable. There are massive risks here. If the market is left to decide long-term rates and they spike, tech stocks and real estate could get crushed. More importantly, if the Fed stops stepping in to catch every market fall, the stock market could behave like a broken kite. Without that counter-cyclical safety net, some fear we're opening the door to a 1929-style depression. It's a high-stakes gamble, fiscal transparency versus market stability. The question is, are you ready for a Fed that doesn't have your back? Kevin Warsh represents a potential future for the Fed that is both exciting and uncertain. It's a future that embraces technological disruption, but also calls for a return to fiscal discipline. For investors, homeowners, and business owners, this isn't just some academic debate. The outcome of this will directly impact your financial future for years to come. It's a story we'll be following very closely, so make sure you're subscribed for all the latest updates. Thanks for watching, and I'll see you in the next video.